So I was saying on the 21st that if there's no close above 53.98, I believe it was, that I would lighten up and start looking for a hedge. So look at this in the last minutes here. So let's see. And it's 15:56, so that's 3:56 Eastern Time. And before that, it made it back up to about 58.60 after a dip down from around that area. And then right there at 3:54, it just fell off the face of the earth. And I did not catch that in time. I thought that once it went back above 58.58 here, that okay, it's going to be okay. But I guess it was a lot of short covering, and then traders started shorting and selling again right at the very end and brought it down below 53.98. And it closed at 58.51.20. And it happened so quick that the real-time Excel price feed, which is real-time Yahoo, was showing 58.58. And it differed from the real-time stock charts Elder Impulse ATRs, which showed the correct price. So this one kept up with those big moves minute by minute, and this one lagged behind, so I missed that right at the very end. Okay, so that's a lesson learned moving forward if anybody's following along. This is the primary real-time S&P 500 price here, and this one is secondary, even though it's much easier to see. Keep an eye on this one first and then look up here. So here's the S&P 500 daily rising line wedge, meaning we're using line, which is closes. And I've been reluctant to show that until we get the third hit somewhere, either on the top or the bottom, and the third hit happened today. So that level for tomorrow morning, price has to stay above 5861.87. And price in the aftermarket hours for the S&P 500 at around 5:40 p.m. Central Time on the 22nd is 58.43. So it looks like it's going to fall out of that rising wedge for tomorrow morning unless a miracle happens. And the measure rule is the peak down here to the valley here at the widest part of the rising wedge. We put it over here where it's going to break out to the downside from, and that's approximately 56.20 or something like that. So a 4% drop. Let's take another look at Thursday's reports, the initial jobless claims, and then the S&P flash services and manufacturing PMIs. So manufacturing is still in contraction mode here under 50, but services is still well above 50 in expansion territory. But it looks like this one's going to be the biggie. And this will have the hurricane factors put into it from the two hurricanes, North Carolina and Florida. And you'll have to factor that out, and I don't know if traders and investors are going to think that the Fed is going to factor that out. If there's a beat to the upside a little bit, so in other words a little worse, I don't think that will be too bad for the markets. It'll probably be welcome, so bad news might be good news there. A beat to the downside, So anything under 200,000, let's say. Because I think this is factoring in some of the hurricane damage to the unemployment rate and jobs. So 150 to 200,000 comes in, and that will be very bad news, and we will be dropping like a rock in the S&P 500 and across the board more than likely.